Welcome, Jim here. A great way to make extra income is selling options. And when you pair it with a really good strategy, something like the option wheel, you can do even better. Today, I want to talk about some great companies that I've been trading on recently that have earned me some really good income. I'm going to actually share with you my trades at the very end of the video, so stay tuned to the very end. And I'm going to talk about my strategy and how it may differ from others. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's jump right in. I typically like to do a quick update about the economy. It's actually doing a lot better than I thought it would be. Also, the market's hitting new highs and we're back into a bull market. So, because of those reasons, I think the Fed's going to hold back from doing any rate cuts. I think a March rate cut is off the table. I'm guessing probably June at the earliest, unless something serious happens between now and then, which, you never know, something could happen. But I'm thinking more like the June timeframe, they're going to start cutting rates. And with earnings currently, any company that misses earnings is being clobbered. Any company that, you know, beats earnings seems to be shooting through the roof. Nvidia went way up yesterday. And then today, Tesla's way down because they missed earnings. And there's been a lot of that going on. I think it actually gives you opportunities, especially for the companies that get clobbered. I actually did a Tesla trade today, the first Tesla trade I've ever done because, they got hit so hard today. And I'll share that trade at the very end of this video. So it does give you some opportunities. It does some really good, valuable growth companies end up, getting clobbered, and you have an opportunity to pick them up at really good prices. So, and that's kind of the main reason for this video, one of the main things I wanted to talk about. So, I really like what I call growth value companies. So, it's companies that, you know, are big, healthy companies, low on debt. A lot of them pay dividends, some of them don't. For instance, Google, in my mind, is a growth value company, and it doesn't pay a dividend. You also have Apple, but they do pay a dividend, but it's a very small dividend. And those are the companies I really like. Now, currently, I don't. I did do a vertical put credit spread in Google recently, but it's blown through the value. I believe Google went up over 150, and I think the vertical put spread was 120, 110. So it's probably going to expire outside the money. Apple, I haven't done any trades on recently, but I would if it takes a hit and goes down to a much lower price than it is today. I feel like the big seven, other than Tesla, are overpriced, and Tesla probably is still a bit overpriced. But the put I sold on Tesla today had a very low delta, so I'm not taking a huge risk on it. But it could potentially go down below that strike price for the put that I purchased. So we'll see. Now, the main thing I like to do with these kind of stocks is what I call it's the wheel strategy, but I kind of do it a little bit different. I like to pick companies that aren't necessarily have the best premiums, but are just good quality companies, stable companies that are going to be around a long, long time that I really want to own. So I like to run the wheel. And if you're not familiar with the wheel, it's simply selling a put. Someone will actually pay you cash or premium for the opportunity to sell you shares. And, so you sell a put, they pay you some money to sell you shares at a certain price. And then if you get assigned, you end up owning those shares. And at that point, you can sell a call. Someone will pay you for the opportunity to buy your shares. And again, if those get called away, then you'll pick up more premium. And it kind of turns into a revolving circle. You sell a put, shares get assigned to you. You sell a call, they get assigned away from you, and so on and so on. Now, how I like to do it a little bit different is with the wheel compared to my normal trading. I do take more risk. I'd use a higher delta, sometimes a 30, 40 delta. And if a company, recently had earnings and it gets hit really hard, like Tesla, also 3M, I'll look at selling a call on them because I feel like they, because of being hit so hard, or even a better value. And I find a lot of times the premium shoots through the roof when that occurs. So, and then once I sell that put, I a lot of times want to keep the stock. I want to keep it forever. I want to, 20 years down the road, look back and, maybe it's doubled or tripled in value. And maybe the dividends, and again, I really like dividend growers, not just companies with good dividend yields. The dividends may be, 2 or 3 times what they were when I first purchased those shares through selling a put. And then the fact that I don't want to give them up is easily, so on the call side, I usually take less risk, meaning I do a lower delta, like a 20 delta for the calls. Whereas if you were doing the true wheel, you would do probably closer to a 30 or 40 delta and bring in a lot more cash with the calls. Since I want to own the stock, I typically do a little bit less of a delta compared to what most people would do with the wheel. And it's worked out pretty well for me. I've ended up owning some really good companies. I have made some mistakes. Everybody makes mistakes. If you haven't made one yet, because you're a new options investor, it'll come, and it's kind of just part of the territory. If you're not making mistakes, you're not taking enough risk. So, so the next important thing I wanted to share was something else that I don't hear many people talking about, especially other YouTubers, is if you do own a lot of shares of a certain stock and it's shot through the roof. Again, let's use NVIDIA. I believe NVIDIA went up almost 20 points yesterday and is selling for 600 and some odd dollars. Well, you could sell a put to protect a lot of those gains. And, if you do a put that's $30, $40 out of the money, you could get it for cents on the dollar. And so if you're in that situation and you own NVIDIA at, say, $650, again, I'm not exactly sure what their price is, but I'm thinking it might be around that. You could buy a put at, say, 610, 620, $40 or $50 below the strike. You can actually look at the pricing of the puts and figure out what works for you, but you can protect a lot of your gains by buying those puts. It's almost like insurance, and a lot of big investors do that. I know Warren Buffett does it, and a lot of other people who have a lot of shares in a particular company will also buy puts as insurance to protect them on the downside. So it's just a good strategy. Now, going along with that is you can also purchase calls. So if you have a company you really like, but you can't afford to buy them at this time, you can buy a call and use a lot less money compared to, buying the stock outright. I did this with Palantir last week. It was in my previous video, and it's worked out pretty well. So Palantir, I believe at the time, was almost $17. So instead of spending $1,700, I spent $600 and I bought a $12 put on, no, a $12 call, excuse me, not a put, on Palantir. So in a way, if it's above $12, and this was a pretty far out expiration, it was a leap, so it was over a year. If Palantir continues to grow, and I think it will, it's more of a growth company than a growth value, but I do think at the end of the year it could potentially be a lot higher. And in the meantime, since in a way I kind of own it, and I spend a lot less capital. I mean, I do and I don't own it. At any time, I can potentially call those shares at $12, which right now with the price being $16.50, I believe, or close to $17, it's almost like owning it. So I can sell covered calls, and that's what I did. So I purchased the call early in the week, and at the end of the week, I sold the call, and I think I made close to $180 on selling the call, and I plan to do that every month. And then at the very end of the year, I would have nearly broken even just with the covered call premium. But then if Palantir goes up to, say, 25 and I own it at 12, then I probably will let the shares just get assigned to me and I'll own it at 12. I could also sell the call at that time and pick up a bunch of premium. I actually compared it Palantir went up to above, I believe it almost hit 18, and I looked at what would happen if I closed it at that point, and I had almost a $400 or $500 gain in literally a week. So it's an interesting opportunity or interesting strategy doing. It's called a poor man's covered call, and I had done it before. I did it with a different company. I did it with Haynes Brand, and I believe over 2 years ago I did it, and it didn't work out well because Haynes Brand went down so much. So picking the right company for any strategy is critical. So that's why I'm hoping long term it does really well. And then, so I'll share that in future videos. And if you go back to the previous week's video, you can learn more about that and the thinking behind it. Another important point I wanted to mention is now that we're going through this bull market, it really works out well if you're doing both calls and puts, meaning you're selling calls and you're selling puts. Because now with the market so high and so many stocks hitting these huge levels, a lot of your puts that you sold will become very profitable and you can close them. And if you haven't already, I suggest taking a look at any current puts you might have that you might have sold and actually look at closing them for a really good profit. And that way you'll be ready for the opportunity when the market takes a dive, and it will at some point. I mean, on a yearly basis, we typically get one correction a year of 10% or more, and I think we get 4 or 5 small corrections every year. So you can just kind of bank on it that at some point a lot of stocks or something will happen and the market will come down quite a bit, and by closing those puts, then you'll be ready for when that happens. And the reverse is true. When the market does dive, then a lot of your covered calls become very profitable and you can close them too for a gain at that time. So having a combination of both really works out well. It's something I've shared in other videos, but I just wanted to mention it again. So those are the main things I wanted to talk about. In the next part of this video, I'm actually going to share with you my trades, and again, some of these value growth companies that I've done trades on this week that have been very profitable. It's been one of my most profitable weeks. So stay tuned. Let's jump into the next part of the video. Okay, this is my planning worksheet that I released this past Sunday to my membership. And when I did release it, I had put any of my positions that were expiring over the next 2 to 3 weeks. And you can see a lot of them are here currently. I'm not going to go through each and every one of them, but they're all expiring on 2/16. The top, I believe the first 9 were the ones I started with it during the week. And I use this spreadsheet to pretty much manage any trades that I have during the week. So again, I'm not going to go into detail with all of these, but I will just talk about how this planning worksheet works. And again, I share it with my community every Sunday. If you're curious about my community, you can learn more below. I have 2 memberships. I have a basic membership that's fairly inexpensive. I share all my trades. I have collections. One collection is almost like a class. I have another collection where I have group meetings for my traders club, and I do that every other week, and I share that with all my memberships, and I have different collections for different purposes. So there's a lot there, and I also send notifications out whenever I make a trade. I get lots of comments and questions. Now, for my more expensive membership, I provide some one-on-one coaching on a weekly basis. It's around 15 to 30 minutes, and I pretty much go over whatever the member wants to talk about. It might be something along the lines of just getting started. It might be something like, hey, take a look at my trades. What am I doing wrong? Or just want to, have a strategy that they want to share with me and to see what my thoughts are on it. So it's worked out really well. I've ended up meeting a lot of people, and I still have quite a few of those memberships left. I have topped it off or said I will not have more than 100, mainly because I don't have enough time to be doing all these meetings. It takes a lot of my time. You can probably hear that I'm a bit tired after a bunch of meetings today. But I enjoy talking with people. So if you're curious, take a look below. And you can learn in the description. I'll have more details, and you can actually jump out to my Patreon and take a look. I do provide a week for free if you want to give it a try to see if it works for you. So that being said, again, I released this planning worksheet. I've got my goals, my weekly goals, my monthly goals. So I'm trying to do 1,600 on a weekly basis, 6,400 monthly. Here's how much I've reached in January. I'm right at 5,708. So I've got a partial week next week, and I've got tomorrow and the rest of today. So I should be able to reach the goal. I increased it ever since I set up rolled my Roth into, or not my Roth, since I rolled my 401k into an IRA and had everything moved to cash, and I've been running the wheel. I've increased it from 4,000 a monthly goal to 6,400. And it's a little bit more difficult to do because now, since I have a number of accounts at Fidelity and a number of accounts at Schwab, I find that I'm in both places a couple times during the day. I typically try to get one or two trades completed a day, and then I move on and do other things. So these are all the different positions that I have expiring. And I'll just mention the companies: PII, which is Polaris, which has the slingshot, a lot of the neat terrain vehicles, and I've invested with them a long time. Currently, I believe it's right around 90 again today. So this one's fairly close to in the money. So I might have to roll it or let it get assigned. Then I have PayPal, which has been beat up lately too. That's another what I call potential value growth company because its PE is like 12 or 13 and it has good growth. I think a lot of people are counting it out and looking at Apple Pay might be the better way to go, but I don't know. PayPal seems to do pretty well. Palantir, this is another trade I had. This is the one I mentioned before, which is the covered call that I sold. And since I just did this one last week and it expires on the 16th, and then once it expires, I'll write another one. And my goal is to make 200 on a monthly basis. When you consider my investment was 2,400 and I can make 200 a month, it's kind of surprising. But that's why I want to try this for a while. I don't know if it was, just the last week. There may be times where it's really hard to get anywhere near 200 or 180 for selling the covered call. This one I actually got pretty close. I think I got 177. I don't think I added that part. Then this is ConocoPhillips, and all the energy companies have been hit pretty hard. So again, they're kind of like growth value companies. They all pay good dividends. I'm more leaning towards XLE, so I may see if I can let this one expire out of the money, and then currently it is in the money, and switch to XLE because I think I'd prefer to have an ETF than a bunch of particular energy companies. But it does have really good premium, and so if it does get assigned to me, I probably will continue to trade on it. Cisco, I love Cisco. I've been working with them for years. I own, I think, 400 shares of Cisco. And I think I have 2 or 3 positions that are currently open with them. Then Google, this is the one, it's way out of the money. It'll expire. IJR, this is what is it? It's a ETF. It's a small company ETF. I've done really well with it. I've owned it for years in my other accounts, and again, has done quite well. This is Palantir. This is my Fidelity IRA. This is a vertical put credit spread that's currently out of the money, but it's closer to being in the money. IWM, which is, this is the Russell 2000. I still have a few of those. This is the last one I had, 175, 165, and it's way out of the money. So you can see I like the green shows that I've actually rolled it. So I did roll PayPal, and I rolled it earlier this week and made $240 in rolling it, which is like a 43% yearly return. And it's currently, did I roll it down? No, I rolled it up a little bit. So, and it's still pretty far out of the money. So I have not done anything with ConocoPhillips. Now, this is Citi. This is a company, definitely a value growth company. It's done really well. I've actually had to roll this up. So this was a covered call at $47, expiring in 315. Fairly profitable already. I think I was profitable in the low 40s. Well, I rolled it up to 52. It should be 52.50, not 52.60, and did an expiration of 117.25. Actually, it was priced at 52.60. The strike was 47. I rolled it up to 50, and I brought in another $189, even with rolling it up quite a bit. And it's a not slow, it's a small dividend return. Almost, it doesn't even meet the dividend, but I wanted to get it out of harm's way. I definitely don't want it to be assigned away from me. The next trade was 3M. This is what I talked about before. I did this on the 23rd. And then 3M just got nailed. This is in my Fidelity IRA account. And I did this as a 90/80. And mainly because 3M, I was a little bit worried about its earnings, and I did want some downward protection. So I am running the wheel. That's something else about the wheel. If I can purchase the outer put for, not too high a price, then I will, to give myself the downside protection. And I did this for an expiration of April 19th. And I brought in over $351. So I still brought in quite a bit. And this was like an 89% return. And I believe it's come back a little bit. I believe it got down to 95, 96. And I believe it's still right around 95, 96. They didn't miss earnings, but they gave projections that were a little bit lower than they were before. They were projecting that the rest of this year would be not quite as profitable as they were originally thinking. So again, a good growth value company, 3M. And I tell you, the world runs on 3M. I mean, their products, they're everywhere. And they've also, worked out these legal issues they had. They've recently settled both with the government. So I think they're potentially sitting nicely. Now, I do think they're a longer term play. So if they get assigned to me, I'll probably keep them indefinitely. BMY, Bristol Myers, they've also kind of been through a little bit of a rocky time. But I had some covered calls at 55 and I rolled those out. It was 50.52, but I rolled it out to 55. So I went a little bit higher and brought in $194. And again, another company pays a good dividend, seems to grow pretty well, not crazy fast, and has a pretty good handle on debt. Now, Devon, another energy company that's been hammered recently, and this I just readjusted a covered call because it got really, really profitable. Is expiring on March 15th. And this, I actually had 4 covered calls. I have 400 shares of Devon. So I closed all 4 and I just rolled 2. And I primarily did that because the premium was good enough that I could, I want to wait a little bit longer, mainly because it being so cheap right now, I would not be surprised if it goes up into the mid to high 40s, maybe the low 50s. So I wanted 2 covered calls that I could write down the road. I'm okay with potentially losing 2 at this $45 range because I really only want 200 shares. I don't want 400 shares. These were assigned to me using the wheel recently. So, and that's primarily, I want to keep 200 for a long time. I really like Devon. I like what they're doing. And even after closing 4 and only rolling 2, I still brought in $244, which was like an 8.6%. And the previous trade I had talked about with Bristol Myers was like a 4% return. So it was a little bit less than doubling the dividends. And then finally, Tesla. This is one I did today. Tesla missed earnings and missed revenue, and their projections were not as good. So everyone was really negative on Tesla, which I kind of go back to the Warren Buffett saying that when everyone's fearful, be greedy. When everyone's greedy, be fearful. So, and I like Musk. I don't think you should ever bet against him. So, I decided this is the first trade I've ever done in Tesla, and I did it today. It's a cash secured put, a 14, just shy of a 15 delta, and it expires on 4/19. They're at the time I made this trade, they were trading at 185, and I brought in $384. So a good pretty penny there, and that's the 15,000 minus the 384.32 to come up with the just above an 11% yearly return. And I could come back if I really worry about them. I could buy a put. So I had the opportunity to buy a $140 put, but I decided not to. But I could always buy it down the road. It's, you can turn a cash secured put into a vertical put credit spread. You don't, some people make it so difficult, but it really with selling options, it's buying puts, selling puts, it's buying calls, selling calls. And everything else just kind of fluctuates. You might have some things expiring on the same day, some expiring on different days. So it's best not to make it too complex. Keep it as simple as you can and don't take too much risk. I've seen some people blow up their accounts by taking way too much risk. And, risk comes from, you see here with the 14, just shy of 15 delta, some people would do 40 or 50 delta. They could maybe bring in 4 times as much, but there's a good chance that they would be assigned, and then Tesla would keep going down, and you could end up having a losing trade, a big losing trade. Or the other thing they do is they'll say like, wow, I really want that $384, let's do 10 contracts. Usually they don't do that unless they're doing a vertical put credit spread, meaning they've got a 140 here or 145 or something along the lines of the put you purchase, meaning the spread's only like $5. So they take a lot more risk. And again, if the trade goes against you, it can go against you in a big way. So at the very bottom here, this is where I stand currently. So all my accounts, I've made 1604, so I've reached the goal for the week of 1604. So whatever I do next or tomorrow will just be, extra icing on the cake, and it comes out to be a monthly return of 0.8, and then a yearly return of 9.6. Now the reason it's lower is because it's a lot of these accounts are completely invested. Like I have Coca-Cola, I have Procter and Gamble. Like I said, I have Devon, I have Cisco, I've got Southern Company, I've got a lot of companies, so you can't make as much when your account is mostly vested or invested. And if you just had pure cash, you could potentially do a lot more. And that's why with this Fidelity IRA, which right now the only stock that I own is GLW, which is Corning, and I think I only own 200 shares. Now, with 735, and the 735 is part of the 1604, it's like a 1.4% monthly return, which is a 16.3. And again, I'm not even done for this week, so this could go up to like 1.5, 1.6. So definitely you can make more if you're just dealing with a cash account. And this doesn't even include the 5% interest that I'm earning on that account, on the cash that I'm using for these cash secured puts or vertical put credit spreads. So that's what I wanted to share. Again, you don't always have to chase these big names. I see so many other YouTubers looking at SoFi and, NVIDIA. There's other opportunities and other good companies to look at too. So that's what I wanted to share. Thank you for joining me, and I look forward to seeing you next week.